In 1995, Tom and Ray each inherited $50,000. They were brothers, same family, same starting point, same year. Tom bought a rental property. Ray opened a brokerage account and put everything into an index fund. They argued about it for 30 years. Tom said real estate was real. You could touch it, rent it, live in it. Ray said the stock market compounded without effort and never called him at 2 a.m. about a broken boiler. In 2025, Tom's property portfolio was worth $890,000. Ray's index fund was worth $1,340,000. Same starting capital, 30 years apart. But here is what makes this story complicated. Tom also collected $2,100 per month in rent for 22 of those 30 years, and Ray's account dropped 50% twice, once in 2001 and once in 2008, while Tom's property never lost more than 18% of its value in any single year. Who won? The answer is not what either of them expected, and it is almost certainly not what you expect either. In this video, I am going to run the actual math on real estate versus stocks across every scenario that matters, including the ones most financial channels deliberately leave out. By the end, you will know exactly which one builds more wealth, under which conditions, and what the real decision actually depends on. Before we get to the numbers, I need to explain why almost every real estate versus stocks comparison you have seen online is wrong, not biased, not misleading, wrong, structurally, mathematically wrong. The real estate argument almost always compares the total value of a leveraged property, a $300,000 house bought with $60,000 down, against the total value of a $60,000 stock investment. This comparison is not apples to apples. It is apples to leveraged apples. Real estate is being given credit for 5 times the capital deployed. The stock market argument almost always ignores rental income, ignores the fact that real estate can be financed while stocks typically cannot, and uses average stock market returns without accounting for the psychological reality that most investors do not hold through a 50% drawdown without selling. A fair comparison requires the same capital deployed, the same time horizon, the same tax treatment applied accurately, and an honest accounting of costs on both sides. Almost nobody does all 4. We are going to do all 4. Let me go back to Tom and Ray and run the actual numbers. Tom's $50,000 in 1995 went toward a 20% down payment on a $250,000 rental property. He financed the remaining $200,000 at a 30-year fixed mortgage at 7.5%, the going rate in 1995. His monthly mortgage payment was $1,398. The property rented for $1,600 per month in 1995. Tom's monthly cash flow after the mortgage, $200. But he also had property taxes, approximately $250 per month. Insurance, $100 per month. Maintenance, averaged over 30 years, typically 1% of property value per year, approximately $208 per month in the early years, rising as the property aged. Tom's real monthly cash flow in year 1, approximately negative $356. He was losing money every month and building equity. By 2005, 10 years in, rents had risen to $200 per month. His mortgage payment had not changed. His cash flow turned positive, approximately $244 per month after taxes, insurance, and maintenance. By 2015, rents were $2,800 per month. His mortgage was paid off in 2025. Cash flow in the final years, approximately $2,100 per month, net of ongoing costs. Property value in 2025, $890,000, consistent with average U.S. residential real estate appreciation of approximately 4.3% annually since 1995 in a mid-tier market. Ray's $50,000 in 1995 went into a total U.S. stock market index fund. No leverage, no additional contributions, just compound growth. The U.S. stock market returned approximately 10.7% annually from 1995 to 2025, including dividends reinvested. On $50,000 with no additions or withdrawals after 30 years. Ray's account in 2025, $1,340,000. But Ray also experienced two catastrophic drops. In 2001, his account fell from $312,000 to $156,000, a 50% loss. In 2008, it fell from $390,000 to $195,000, another 50% loss. Both times it recovered and went on to new highs. Both times required doing nothing, which is psychologically much harder than it sounds. Now let's run the apples to apples comparison. Same $50,000, same 30 years, every cost included. Real estate, total return. Property value, appreciation. $890,000 minus the original $250,000 purchase price, $640,000 in equity from appreciation. Equity from mortgage paydown. The $200,000 mortgage paid off over 30 years adds another $200,000 in equity. Total equity, $840,000 on a $50,000 initial investment. Before rental income. Rental income, Tom collected approximately $612,000 in gross rent over 30 years. After mortgage payments, taxes, insurance, maintenance, vacancy periods, and occasional capital expenditures, a new roof at year 18, HVAC replacement at year 22. His net rental income over 30 years was approximately $89,000. Total real estate return, $840,000 in equity, plus $89,000 in net rental income, $929,000 in total wealth creation from a $50,000 investment. Return on initial capital, 1,758%. Annualized return, including leverage and rental income, approximately 10.1%. Stocks, Total return, $50,000, growing at 10.7% annually for 30 years, with dividends reinvested, no additional contributions. Total stock return, $1,340,000 in wealth creation from a $50,000 investment. Return on initial capital, 2,580%. Annualized return, 10.7%. Stocks win by approximately $411,000 over 30 years on the same initial capital, but by less than most people assume, and with significant caveats on both sides. Subscribe before we go further. This is where the comparison gets genuinely interesting, and next week connects directly to this. Quick note: I am not a financial advisor, and everything on this channel comes from personal research and analysis, not professional credentials. Real estate and stock market returns vary significantly by location, timing, and individual circumstances. The numbers I use here are based on historical averages and are illustrative examples, not predictions. Always consult a qualified financial advisor before making any investment decisions. Now, let's continue. Here is where the simple answer, stocks win, becomes more complicated. Caveat 1. Leverage changes the real estate math dramatically. Tom deployed $50,000 but controlled a $250,000 asset. That 5x leverage amplified both his returns and his risks. If he had put the same $50,000 into real estate without leverage, paying $50,000 cash for a small property, his return would have been significantly lower, roughly $180,000 in appreciation, plus minimal net rental income on a small property for a total of approximately $220,000. Stocks win by a landslide in that scenario. Conversely, if Ray had borrowed to invest in stocks, matching Tom's leverage ratio, his returns would have been astronomical in the good years and potentially catastrophic in 2001 and 2008. Most stock investors cannot access 5x leverage at 7.5% fixed for 30 years. Tom could, because the property itself secured the loan. The real estate advantage is not the asset class. It is the financing structure. Banks will lend 80% of a property's value at fixed rates for 30 years. They will not do this for stocks. That financing advantage is real and significant, and it is not available in the stock comparison. Caveat 2. Taxes treat real estate far more generously than stocks in most scenarios. Tom benefited from mortgage interest deductions, property tax deductions, depreciation, which allowed him to deduct approximately $9,000 per year in paper losses against his rental income despite the property appreciating, and ultimately a $500,000 capital gains exclusion if he converts the property to his primary residence before selling. Ray paid capital gains taxes on dividends every year. When he eventually sells, he pays long-term capital gains on the full $1,290,000 gain, potentially $193,500 in federal taxes at the 15% rate, or $258,000 at 20%. After a careful tax analysis, the gap between the two strategies narrows significantly, from $411,000 to approximately $180,000 to $250,000 in stock's favor, depending on Tom's tax situation and whether he uses any of the available real estate tax strategies. Caveat 3. Effort and risk are not equal. Ray's investment required one decision in 1995 and 30 years of doing nothing. No phone calls, no maintenance, no tenant issues, no liability, no local market dependency, full liquidity. He could have sold $10,000 worth of stock on any Tuesday morning. Tom's investment required continuous management, or a property management company taking 8 to 10% of gross rents. It was illiquid. It was geographically concentrated. A flood, a major tenant lawsuit, or a neighborhood decline could have permanently impaired its value. And unlike Ray's diversified index fund, Tom's entire real estate position was in one property in one city. The additional $180,000 to $250,000 that Ray ended up ahead is in part compensation for the simplicity, liquidity, and diversification of his approach. Whether that premium is worth the difference depends entirely on the individual investor. Here is the honest summary in 3 scenarios. Scenario 1. You are a passive investor who will not actively manage property. Stocks win. Not by as much as most people think, but clearly. A low-cost index fund held for 30 years beats an unmanaged, poorly maintained rental property almost every time. The management costs and vacancy losses of neglected real estate eliminate the leverage advantage. Scenario 2. You are an active investor willing to manage property or afford a good property manager in a market with reasonable appreciation and rent growth. Real estate is competitive with stocks on a total return basis, and often superior on an after-tax basis due to depreciation and the capital gains exclusion. The leverage advantage is real. The tax advantages are real. The cash flow in later years is real. Scenario 3. You want both. This is what the data actually suggests most high net worth individuals do. They hold index funds for liquidity and simplicity. They hold real estate for leverage, tax advantages, and income. The combination, not the either-or, is how most genuinely wealthy people build and preserve wealth over decades. Tom and Ray, in the end, agreed on this. Tom moved some equity from his property into index funds after the mortgage was paid off. Ray used his investment gains to put a down payment on a rental property at 58. They stopped arguing. The data had settled it. Here is what I want you to take from this video. The real estate versus stocks debate is not a debate about which asset class is superior. It is a debate about which vehicle is right for which investor at which point in their life. Stocks are superior for passive investors, people who value liquidity, people who cannot or do not want to manage property, people with less than $50,000 to deploy, and people who want geographic diversification. Real estate is superior for investors who can access and sustain leverage, people in markets with strong appreciation and rent growth, investors who understand tax strategy, and people who want inflation-protected income in retirement. The question was never which one wins. The question was always which one is right for you. And the answer, almost always for almost everyone, is some version of both. Here is what I want you to do this week. If you currently invest only in stocks, ask yourself honestly whether you have ever seriously evaluated real estate as a component of your portfolio, not as a replacement, but as a complement. The leverage advantage and tax treatment are real. If your answer is no, spend 1 hour this week reading about real estate investment in your local market. If you currently invest only in real estate, calculate your annualized return honestly, including all costs, all vacancy, all capital expenditures, all management fees. Compare it to what a simple index fund would have returned over the same period with the same initial capital and no leverage. The number may surprise you in either direction. If you do both, verify that your allocation reflects your actual goals: income growth, liquidity, tax efficiency, rather than the allocation you ended up with by default. Most people's real estate to stocks ratio is accidental, not intentional. Tell me in the comments, are you team real estate, team stocks, or do you hold both? And what is your honest reason, not the financial reason, the real one? I read every single comment. Subscribe, because next week we are running the real math on the 401k versus the Roth IRA. The same format, the same honest accounting, and the answer that most financial channels get wrong. You will not want to miss it.